Meanwhile, folks, the S&P 500 on the cusp of all-time highs and the NASDAQ on track for yet another record close. Now we need the Dow to break out. How is all of this really, what does it all mean for you? I want to bring in the Fitzgerald Group principal, Keith Fitzgerald, along with Nicholas Wealth Management President David Nicholas. Keith Fitzgerald, the S&P is right there. Now, I think if we break out, buying could trigger more buying, but you think there could be a different reaction, right? You think there might be some celebration and profit taking?
I do, and here's why. I think it's going to be a short, sharp burst of profit taking because many of the hedge funds, many of the New York institutions that are talking a good game right now, Charles, in fact, have missed out on much of this rally. So they've got to get a few names on the table when they come into bonus season for window dressing. So I think there's going to be a short, sharp takeoff. Then we're going to see the real buying begin into the elections.
David, S&P 500 closes at a new all-time high. What's next?
Yeah, I think, I somewhat disagree with Keith there. I do think if we're heading that way, if we can break above the 3386 number, break above and close there, I think it's horses right to the races. I think the markets are going to head up because I really think it's fear of missing out at that point. I think it's going to take a lot of money out of the sidelines. I think if we can break through that and close above a very bullish signal, I think we'll see that trend continue.
The fear of missing out, the train is leaving the station. We can go on and on. I'm more with you than Keith on this, but Keith did bring up an interesting point, right? Coming into the session, there's a lot of cheering about rotation finally happening from growth to value. Lifted 223 names in the S&P to the green for the year. That's the highest level of all of 2020. But, something interesting happened yesterday, Keith. The tables started turning again, and folks rushed back into the safety and the comfort of those growth names, hence the big move in NASDAQ today. You still sticking with them. You say stick with the best no matter what. Stick with these growth names.
Absolutely. It's best, not rest, because those are the names, those are the companies that are digitizing your life. If you look at history, it moves in broad trends that are driven by the dominant change in society. Right now, that is the digitization of your lifespan. That's the 5 and 10 years from now. So that's why the money's going back. It's liquid, it's solid. The companies, the CEOs know what they're doing. I am in it to win it with those companies.
David, I've been overweight industrials and materials, but I never sold my growth names either. How do you think investors should be sort of situated here?
Yeah, and I like a 50-50 approach. So I agree with Keith there, where I think 50% of your portfolio should be in those large cap quality balance sheet tech names. Those are going to outperform the next 3 to 5 years. But I also like 50% of the portfolio to be in some of the value/recovery names. My bet is on the U.S. consumer. I like a name like Big Lots. I like a name like Dollar Tree. I've talked about how I like financials. I think Citigroup's a good buy here. I like the home builders. So I think the consumer is going to be poised to come back strong. Once the elections get out of the way, I think we're going to see a fourth quarter that really looks good. That bodes well for some of these value names.
All right. Hey, guys, I want to talk about the bond market. We don't talk about it a lot, but these yields started rising on the 10-year. The curve is very strong. It suggests that the economy is strong. Is it possible, then, Keith, we can get both growth and value up if we get enough money out of bonds?
I think the answer is yes. And today's point, you've got to have this bookend approach. You've got to be tech-driven on one side, value-driven on the other, growth, however you want to split it, because the money is going to constantly ping-pong. If it's coming out of bonds, it's logically going to be looking for a home, and that home is in stock. So I think we're going to get both on the run.
David, as much as I hear experts come on TV all day long and talk about the so-called Tina trade, every single week, billions of dollars goes into bond funds and billions of dollars come out of equity funds. I mean, if we could ever get that ratio turned around, what could that mean for the market?
Yeah, I think it'll be huge, Charles. And, I think the bond market is very telling, though. I think if you see, we've seen what yields have done this week. I think the vaccine news out of Russia played a part. We can't put a lot of weight on that. But you know what? We've defeated whether it's been, Nazis, communists, terrorists, now COVID. We're going to defeat this as well. And I think what the bond market is telling us, it's saying, look, the outlook for this is probably going to be better than expected. So I think there's that issue there. But I also think we've got to look at prices as well. I think we're starting to see some inflation. So I think as we see those two combine, right, the hope, possibly some inflation with wages, individuals getting back to work, that's where I think you're going to see bonds perform poorer. Right. And I think the narrative is going to move towards equities.
All right, let's hope so. I'm greedy. I want this rally to continue for a little bit of time, like 3, 4, 5 more years. Keith, David, thank you both very much. Appreciate it.